Okay, hello and welcome. We are day four of the 10-day Planning for Profit Challenge. And today we are looking at our revenue stream. So just a couple of housekeeping notes from yesterday. Thanks again, everybody, for all of the questions that came in. I have been noticing that when I send out my emails and I put the link to the video drill, it's a link that takes you to the Planning for Profit equipment room. But what I've noticed for some of you is that depending on whether or not you're currently signed into the Epiphany site as a member, you get in. If you're not currently signed in as a member, it doesn't accept the password, and it unfortunately is not booting you into the space of, log back in as a member. So in the future, what I'm going to do is I'm going to put the link to get you to the Epiphany homepage, and then you can either, again, sign in as the member or log in as a member and then get into your equipment room. But that's what the glitch has been in the past. So thank you for those that have weighed in. That was a tough one to figure out, but we got that figured out. Okay. Today, believe it or not, this is actually going to be, hopefully a pretty simple day for you. I'm going to ask you to keep it really simple because myself included, I have a tendency to make this more complicated than it needs to be. And why I want you to keep it simple right now is because we have, especially for those service-based businesses, we have some very heavy lifting to do tomorrow. And the more revenue streams you've identified today, the more lifting you're going to have to do tomorrow. So I'm going to, tomorrow, actually, I'm going to just show you quickly what we have to do. In Pricing for Profit, just so that you're aware, we have 4 different phases to go through. So phase 1 being the design, phase 2 being development, phase 3 being delivery, phase 4 being defending. I'm going to explain all of these tomorrow. And in each one of those phases, we have your indirect labor or your employee labor. We have all of your materials and inputs, and then we have all of your direct labor or your subcontractors. So you can imagine if today you decide to have 10 different revenue streams, you have to go through this exercise, and this exercise is going to take you, I suspect, if you're service-based, it's going to take you at least 45 minutes to an hour for each revenue stream. So I'm giving you that as a preface to make sure that you don't overcommit on revenue streams right now, today, so that tomorrow you can, or over the course of the weekend, you can keep it lighter for yourself. Okay, so today, revenue streams. All we are looking at doing today is this top left-hand corner of your tab 3, Forecasting for Profit. Let me close that. Sorry, that's annoying. So this is the only thing that we are working on today. We are not working on pricing. We are not working on mapping out your assumptions. We are not putting in any historical data in here right now, new. And we're not doing any cost of goods. We're keeping this very, very clean today, very simple, very easy for you. All we are doing is charting your revenue streams. Now, ideally today, I would like you to come up with 2 to 4 maximum, because again, remember, depending on how many you decide to list today, you are going to have at least an hour of work for each one of those revenue streams tomorrow. So let me talk to you a little bit about what revenue streams are. Revenue streams, just to make sure that we're all very clear on this, revenue streams are the products or the services that your business sells, right? It's not the forms of currency that come in, because I know we had a question from one of our member saying, well, should I list all of these sources? So whether it was insurance or government money, those specific, that was more about how you are compensated, right? So you delivered a product or service, and then how you were compensated might have been a credit card, it might have been a government subsidy, it might have been insurance that came in from someone. So that's the form of compensation. but it is not the service or product that you originally offered to be able to get that compensation in. So I hope that that's clear. The revenue stream is exactly what it is that you're selling or offering, right, to the customer. So revenue streams are also known as income, top line sales, sales, profit centers, gross income. All of those terms define the same thing here when we start talking about revenue streams. So what I thought I would do, because again, this is a very simple day, but I want to give you a couple of examples, and I thought it would be best to show you some examples of when I've worked with clients in the past, how we have started to categorize the different revenue streams, and where we started very simply, and then as they got more comfortable with it, you can always come back and start to break out these revenue streams and offer more complexity to the cash flow forecast, right? The forecast for profit, if you wish to do so. But why I want to keep it simple today for you is very similar to like the gym analogy, right? We have 2 weeks together. I want us at the end of the 2 weeks to have a finished product. I want you to feel like you've achieved results, because if you achieve results and you see something that's come together, you're going to feel good about it. And then you can come back and you can add more to it. But if we make it super complicated today, the likelihood that you're going to finish this exercise and finish the challenge with a completed product is going to get tougher and tougher and tougher for you to do. So just keep it simple today, please. Okay, I think I've mentioned that enough. I think you get it. So here's some examples. Oops, and you can see that I was right in the middle of typing these out because it's not a woman's clothing shop. It's a woman's clothing shop. As we go through these, you might sense that some of these examples are resonating with your business model as well. So that's why I want to use today to go through some of these examples, and then I'm going to open it for questions. But again, today's a really light day. Tomorrow we have the heavy lifting. So for example, in a woman's retail clothing shop, right, revenue streams might include, so now I can hear all of you who have retail, you probably have anywhere from 10 to 20,000 different SKUs going on, right? I know I'm speaking to some of you directly. I need you to start categorizing how these fall into different buckets. So for example, women's clothing, you might have casual wear, you might have business wear, you might have formal wear, and then you might have accessories. So today I would ask you just to stick with those 4. As you get more comfortable with this, you could start to now break them down into clothing wear, jeans, tops, bottoms, and business wear, suit, blazers, bottoms, whatever that may look like. But please break these down after the challenge. Today, just put together your 2 to 4 main categories within your business model. A shoe boutique that I worked with, it was interesting because they're like, well, how am I going to categorize shoes, right? What are we going to do? What we realized, because there's some key indicators that you want to be aware of, and I'm going to show these or share these with you in the email today, and I think I put them in here somewhere. Key indicators, if we look down at the bottom, typically the price that you're offering it at, the expertise required to actually offer that product or service, the time in, right? So it might be an hour, or it might be a project that's going to take, 250 hours, 2 very different revenue streams, and then the materials required. So a small renovation project versus an extra large renovation project, very different material requirements there. So before I lose you, let me come back up here to some examples, because hopefully I think the examples will start to make more sense for you. So for example, a shoe boutique, they had what they called their essential line, their essential label. And under there, they had men's, women's, and kids' shoes because they were all priced very differently. And then they had their premium label, men's and women's shoes. But before we started working together, they were literally trying to manage, I think it was something like 60 different brands. And then each brand, each season came out with all of their own SKUs. So we just started to categorize in that way. Here's an example of a pet store. So a pet store, Basically, it was like everything. There was like all the food, and then there was all the accessories, and it was all kind of blended together. So we ended up separating it into raw food category because that came at a premium, the dehydrated food, right? And then in each one of these, as we got more sophisticated, right? Because again, I'm working with you online. In these examples, I got to work with these customers one-on-one through a mandate that was $9,000, and we got to spend about 10 hours on this alone. So, and cost of goods. So I don't want you to kind of beat yourself up if you're having a hard time over it. I just want you to keep it simple, and that's why I'm sharing these examples with you. So raw food, there was a couple of categories, dehydrated food, a couple of categories, supplements, right? And then living and decor and cleaning and maintenance. But they started to realize that about half of their business wasn't relevant to what their real passion and mandate was. So they were carrying huge loads of inventory to try to be seen as this, local neighborhood food store, pet store. But at the end of the day, what they really wanted to be about was nutrition and health for the animal. So this exercise might bring to light a lot of kind of ahas for you to go, wow, we're holding on to a lot of stuff that isn't necessarily in our zone of genius and brilliance, and maybe, right, it's costing us plus the interest, and we're not generating a lot of revenue on it. So something for you to think about. Here's an example of a manufacturer that I worked with that actually does cultured stone veneer. So you probably know on the front of every house and building, there's all this stone that goes in now. So they're a manufacturer of it. And what we decided for their revenue buckets, because in the past it was just, I sell stone, that's all I sell stone. So we broke out 2 buckets, one for wholesale, and then with their stone, they have category 1, which is their regular stone, and then category 2, which was their custom stone. So custom designs where they build a very unique mold for that wholesaler, so that wholesaler can say, this is X stone, but designed for us, right? So that came at a very different price. Plus there was more labor involved because they had to do a custom mold. And then they had a very different rate for distributors. So the wholesale, this is 50,000 square feet or more of veneer. And then the distributors, this was 10,000 square feet of veneer. It came at a very different price, but they still had the 2 categories of typical stone and then custom. Construction, this is the example, customer A or client ABC construction company, right? So they realized that they had, instead of everything in one bucket, they had renovations, medium projects, large projects, extra large projects, and then they had house builds. And their house builds, we didn't do small, medium, and large because they knew that their sweet spot was the house that was typically on average about $650,000. That's where they wanted to sit to be able to make the money and provide the service and the expertise that they knew they had, that they were very, very good at. An entertainment facility I worked with. So again, service-based, but now this is almost service retail, right? Because they have brick and mortar. So they had a drop-in rate. They had a room rental rate for birthday parties, or if somebody wanted to rent the room. They also did equipment rentals. So they would rent their equipment and then bring it on site to the customer. And then they had the canteen, which was kind of like their food bar, food service area. So again, we're keeping it really simple. A lot of these companies said, oh, well, I have 25 revenue streams. Again, very hard to manage. And what we're looking for here, why we're trying to figure this out, is we need to know what sales we need within each one of these categories. So again, if you have 10 to 25 categories and you're one business owner, this becomes really hard, becomes more and more challenging with each revenue stream to try to manage each one of those from a marketing perspective. Because in most cases, each one of them needs to be marketed a little bit differently because it usually has a different audience, with the exception of this entertainment facility where they were very lucky because everybody was the same audience for the most part. Here's an example of a clinic that I worked with, and this would also work for a spa. I'll give you an example. So this was a health clinic. So they usually just lumped everything up into hourly services, but we started to break it apart. So we had body work. So in the area of body work, they had service 1, 2, 3. That was it. Kept it simple. In counseling, they had hourly counseling, and then they had retainer-based counseling. So that was it. Now, what we did start to add on for them at the end, because it is challenging sometimes to just budget based on hourly services all the time. So what we ended up looking at was creating a couple of packages. So for those of you out there that are experts in your area that are hourly based right now, the question becomes, for the customer to experience the ultimate benefit and to achieve success with your service, how many sessions, how many hours are actually required? Right? And then you put a package around that because you're the expert. Sometimes, like if I'm doing money coaching and someone says, well, can I hire you for an hour? You absolutely can, but I can almost guarantee you're not going to see any results unless we're tweaking, right? But I offer a money mastery matrix package, and you're going to do this and this and this and this and this, and this is exactly how our time together is going to work. And for that, you're going to be charged X, right? But here's the benefit of it. So hopefully that makes sense to you. If we took a look at this from a spa perspective, this might be nail work, right? And it might be hands and then feet. And I know a lot of you are going to want to drill down. Well, and then there's basic nails and then there's shellac. And again, too much. Just take an average, right? Like let's just bundle it and make it as clean as possible. You might then have body work here, right? So what are all the massages? Or you might have aesthetic work there, right? So just understanding your main buckets for today, and then we can drill down after. I'm not saying you can't drill down, but not today. The next piece, I'm using this as one of my examples. So if I'm offering business consulting and coaching, I started off with hourly, then I put together packages for one-on-one, right? And then once my time reached capacity with one-on-one, then I went to online challenges, right? What you're doing here today, so I can reach more people with my time because I was at capacity here. And then I also bill out for projects. So for big corporations, so for example, I'm working with a number of credit unions now that want to build micro loan programs for entrepreneurs in their provinces. So I will bill out on a project base. I've got a whole different fee schedule for that, right? But we're not talking about fee schedules now, and we're not talking about when we receive the revenue or how we receive the revenue. We're just talking about the bucket itself. So that's an example of mine. Here's an example of a nonprofit, because I know we have several of you on the call today. So nonprofits, typically your revenue buckets, how you make your money, usually sometimes through memberships, right? So you get your community to invest into you, and you charge, you might have a couple different types of memberships. Maybe there's a corporate membership, maybe there's an individual membership. I don't know how it works for you, but oftentimes with nonprofits, there's also government funding, right, or subsidies. So source 1, 2, 3, what that might look like for you. And then oftentimes there's sponsorship, right? So I took some examples of what I commonly see with nonprofits when I'm working with them, and these would become your revenue buckets. So I hope that that is clear. I actually, as I started to, as I was preparing for my call, I was like, oh, I should put an example here of service as a software. So SaaS, S-A-A-S. Some examples here may be, so one company that I worked with, they just saw it as, oh, well, we're technology, and we had to weed through it. But what we ended up with is we ended up with the technology itself. Even though there were all these bells and whistles that they could turn on or off, we knew that on average, their customer base was either going to be medium enterprise or large enterprise. And for medium enterprise, we had an average transaction because we knew that usually these are the features that they are looking for in the software. So on average, per medium-sized client, we knew that we could say, okay, it's going to be X. So one of our revenue buckets was medium enterprise package. The other new revenue bucket was large enterprise package because they wanted a lot more bells and whistles and they had a lot more users. So that was the technology. And then we got into service. So even with service, we put together packages. So with this package with the technology, and this is, if any of you are doing technology and app development now, yes, there's always bugs to work out, and we included that in the technology itself. So when we're selling that package, that comes with X number of hours of working out bugs, right, to make sure that it works for that customer. Service is a completely different story. Service was about making sure that the implementation worked, that the users were all using it properly. It included training, and it included hearing how the technology potentially needed to be fine-tuned to meet their specific requirements. But that's not a bug, right? That is you customizing based on what they need. So we put together a couple of service packages where we had set number of hours, because this, in software, this is where they were hemorrhaging their money, because they thought that, well, we just need to do more and more service, plus it helps us build our business, because anyways, we got it fixed. So those were their revenue buckets. Everything else we found a home for, but that's an example there. Okay, what do I want to mention to you today? Some tips today. Again, I really want you to keep it simple. I think you guys have that by now. I've mentioned over and over again. Identifying the profit center. So when you're thinking about where should I start, what are my revenue streams? If, you know, hopefully, I know that they were probably all lumped as sales in your profit and loss report, in your notice to reader. Hopefully in your bookkeeping report, you either have some revenue streams in there, so that's great. So I just want you to take a look at, for whatever ones you have listed, I want you to take a look at where is your business generating 75 to 80% of its revenue, because that's what we're going to focus on. For those of you that had 75 revenue streams listed, we're going to have to simplify. So how do you start creating the buckets? And you might find that, you know, just like we did in the retail piece, you might find that you can create several buckets looking at, okay, this seems to all be lumped together, this seems to be lumped together, and this seems to be lumped together. Let's take our 3 to 4. And again, I'm not saying that we can't get into detail later, but I want to make sure you get a finished projection by the end of our challenge, and then you can add complexity to it. 2 to 4 at most, and please don't forecast sales. The whole idea of this challenge is to actually plan for profit. So we need to make sure that we know our revenue streams. Why we're doing this today is because tomorrow we have to assign the cost of goods to each revenue stream. And then I'm going to show you, all we need are 3 numbers. We just need your expenses, we need your cost of goods as a percentage, and we need to know what you want your profit margin to be. Once we understand those 3 numbers, it will actually show us, the runways light up, and it'll show us exactly what our revenue needs to be. Then we break that revenue out into your streams, and now you will have sales goals that actually allow you to achieve net profit. So now that that's clear, just a couple areas here. So key indicators, again, with respect to, oh, this needs to go in this bucket, this can go in this bucket. Take a look at your pricing, right? So for example, hourly of $225 versus project-based at $25,000, 2 very different revenue streams, 2 buckets, right? One's project, one's hourly. It might be that you have one item that's $10, and then you have another item that you're selling for $250. I suspect those are 2 very different revenue streams, revenue buckets for you. Expertise. Is there a different level of expertise that's required, right? If we look at the clinic, excuse me, body work versus psychology, 2 very different revenue streams, right? Time in 1 hour versus 3 months, right? Or transaction based, I'm going to sell you this box of strawberries versus I am going to cater chocolate covered strawberries to you, 2 very different revenue streams. And then materials in, I use the example of a small renovation versus an extra large renovation, right? Very different. So we're just going to separate those. And in that case, actually, it's actually expertise, time, materials, all of that is definitely going to change there. So in some of these cases, it might be all 4 indicators. In some, it might just be 1. Okay, that is what I have for you today. So again, I just want you to have 2 to 4 revenue streams at the very most. We are not touching, if I go back here, I'm just going to show you our demo of our construction company over here. you will see that what we did here, we had renovations, medium, large, extra large, and then custom homes. Space rental, you know what, arguably I should have taken it out, but this was they were renting out their space. You know what, in the future, that just confuses everybody. So we'll leave that out. Don't mind the space rental. But so 4 major revenue streams. This is the only area that we are touching today. We are not touching price, and we are not touching assumptions. Okay, I think I'm clear on that. Okay, as always, I am going to now mute myself and allow everybody to weigh in to see if you have any questions. Okay.
Hi, Tanya.
Hi.
Should I be doing this then by project? Our pipeline, we build so many meters of pipeline, and they're always variable. So I'm not really sure how to break my revenue down.
So yeah, I think in your space, your customers are typically corporate customers, right?
Yeah.
So I would base it by project, and I'd take a look and I'd go back and I'd say, do you have small projects, medium, large projects? Like, how do you break projects down? Or do you break it down by square foot of pipeline that you bring in? But I would actually probably do it by project.
It's usually, it's usually by the meter. We don't very often do bid jobs sometimes, but they're not as common.
Okay.
So for the most part, you're building a pipeline that's so many meters, and we just go out and do it. We don't have to do. There's a ticket created every day for men and equipment.
Yep.
And that's submitted to the consultants, and then it's invoiced.
And how many customers would you work with regularly, would you say?
The most common,
yeah,
there's 2.
So there's 2.
Yeah, but there's probably 6 altogether.
And so when you look at so there's 6 altogether. When you look at generating new business, do you look at trying to get more business from existing customers, or do you look for new customers?
We don't have to look for new customers. They come to us. They just know, they know the reputation of the company.
And do you charge out based on meters?
No, well, no, because it's charged by hours, equipment by the hour, men by the hour. And if, for example, if we had to supply some products, then we would, mark that up and charge them for that on the invoice, but that's rare.
Okay.
Just men and equipment, man hours, equipment hours.
So when you're putting together a proposal, is the proposal done based on the project?
When we do make a bid, it's based specifically on that project, and Keith takes into consideration how many meters, and he knows in his head roughly, how many it costs per meter. But then in the bid, he has to break it down for how many homes that he needs, or excavators, and how many men, how many picker trucks, everything that he might need.
Yeah. So I think, again, if not knowing your whole business model, but it sounds like I would put together your revenue streams based on small, medium, large projects. Yeah.
Even though we could have 60 projects or 80 projects in a year?
Absolutely. Yeah.
Okay.
Yep. But I'm going to show you one of the things too. I'm glad you mentioned this, because one of the things, if you have a really light day today and you're like, oh, I'm already done my homework. Woo! One of the things that's going to be important for you, and we talked about this in your phone call, but under equipment costs, right?
Yeah.
So you have equipment costs.
Yeah.
Those of you, whoever's listening, that have a business that is heavily weighted on the equipment that goes out regularly, so either it's equipment rental or it's excavating, or, I would start this process, Sherry, because this, depending on how many pieces of equipment you have, this is going to be very important to your work tomorrow on your cost of goods, right?
Great.
So this is just where you're going to list each piece of equipment, the year that it is, the original value, the lifespan that it has, the interest rate that you currently carry on it.
Yep.
as well as then over here in monthly maintenance, monthly insurance, and it's going to show you exactly how much that piece of equipment is costing your business on a monthly
Yep.
and then daily cost.
And I would like to know that. I mean, I ballpark it, but.
And those numbers, yeah, those numbers we can take over into our pricing tab tomorrow. It will be really simple for you. So sounds like your homework is already done today because you're just doing small, medium, large projects. Now
I just don't know what to classify small, medium. I'll have to talk to Keith about that with regards to meters of.
yeah, and actually you don't even need to know that right now because
No.
we're going to figure that out later. We just need to know what the categories are right now.
Oh, okay.
Because what will happen then is that when you start pricing for profit, we'll have a baseline of what all of your costs are. And the idea of pricing for profit is that we always end up with a very specific margin for our cost of goods. Right? So you don't even need to worry right now about what your prices are. We will get through that together later on. Okay.
All right. Thank you.
Thank you for sharing that. That brought up an important piece here on the equipment cost piece. Okay. Any other questions? I think I need to allow some people to talk here. If your microphone is muted, I'm going to let you unmute yourself and then weigh in your question if you have any.
Hi, Tanya.
Hi.
I feel like I'm done my homework as well today. I also don't feel that the equipment cost is something I need to worry too much about either.
Okay.
As all my equipment is paid for basically already, other than the pieces that need to be replaced as they expire.
Okay. Okay, perfect. And can you remind me what your primary services are then? What are your revenue streams?
Well, I do cosmetic laser, and so
Okay.
I split them out according to the machines that I use. I think
Okay.
my 3. I do hydrofacials, which is a separate machine, and then massage, which requires no machines.
Okay. So I get what you're saying about the equipment, that the equipment is already taken care of. Can I ask, before, how did you set your price?
I researched other companies, what they were pricing, and just tried to price according.
Yeah, so
that.
that's how most people do it, right? And
Right.
you're absolutely not wrong to do that. However, it could be compromising you, because if we know that most businesses are operating at a 2 to 5% net profit, this is why we all go down together, right?
Right.
When we start pricing on what our competitors are doing. So you might find it really interesting to actually do this exercise regardless, and to list the equipment that you had and the interest to actually see what it was costing you on a daily basis, because that will help with your pricing strategy as well. Even though the equipment is already paid for, right?
Okay.
You incurred a cost for it. So just trying to understand overall what that daily cost would be, right? For like, even just take your monthly payments and divide that by, how many days you were open, you're going to get a really good understanding of what that carrying cost was. And then that will help you to better decide then going forward that just to use that equipment on an hourly basis, regardless of all the utilities needed for it, it's like, oh, well, that piece of equipment actually cost me, $30 an hour, not to even mention the labor. So it's, it's an interesting tool to go through for pricing that we'll get into tomorrow.
So I'd have to try to remember how long they've been paid for so long. I can't remember how long I paid on them.
Yeah, well, you know what? Even if you look at your loan, you're going to understand what your loan payment was per month.
Okay.
Right, on that equipment. That's an easy fix for us to, we don't need to get into the minutia of it, but how much did you pay for it per month, right? So that you understand that cost, and then you can break that down by day and then by hour if you like.
Okay.
Okay, does that help?
Yes, it does. Thank you.
Okay. I will say, one of the businesses that I was helping with as well, when I was consulting with them, they had was like a tanning business, but it was also like one of these hydra centers, right, with water and red lights. And it was amazing because they had never factored in those equipment costs before. They were just listed as operating, which is totally cool because that's, we have to pay them regardless of whether we sell anything or not. But when they started to understand how much they were actually paying every month for the equipment, and especially with the water that was being used for each specific treatment, it was definitely an eye-opener for them. So they adjusted their price, and then they also made sure to build value around it, right, to make sure that it wasn't, oh, we've just gone up by 15%. But it's definitely an eye-opener, and this is again where a lot of businesses are losing their money. So you can get started on this one as well with your equipment costs. All right, great questions, everybody. I like this part. It's very interactive. It's nice. It feels like I'm not speaking to myself. It's awesome. Any other questions out there? Even from the other days, if anybody wants clarity to make sure that we're all right at the same place and we're on track. I see a hand. Don't know what to do with hands. What do I do with hands? I see a hand, Alyssa. Do you want to, you're unmuted, so you go ahead and ask your question.
Yeah, so we're fee for service for physiotherapy.
Okay.
So playing catch up a little bit here, so please forgive me. When I entered in all the operating costs and the personnel costs and stuff like that, I don't know what to put in for direct cost for each service.
Sorry, are you talking about forecasting for profit where you did this, or are you talking about charting the data?
Charting the data.
Charting the data. Okay.
Yeah.
When it comes to charting the data, you will see if it's on your notice to reader where it said direct costs, that's the number that you're putting in. If there was no direct costs on your notice to reader, and oftentimes with service-based businesses, because it's mostly labor, it's mostly employee labor that's going into it, a lot of accountants won't recognize any direct costs associated with it. It's just all considered operating. So if you don't have it on your notice to reader, you don't need to worry about it.
Okay.
But I am going we're going to change that tomorrow, because you will be surprised to realize that there are a ton of costs associated with that service that haven't been categorized properly. And it's probably adjusted or will adjust your price, hopefully, going forward.
Because like I do know, like for service, you know, there's the ultrasound gels, the machines that we're using, the bedding that we're using, washing of the bedding, and so on and so forth. But that can be considered as a direct cost, or would that be considered more of an operating cost?
So I know this is going to get tricky for everyone tomorrow, but what I'm going to do, even though we have them listed as operating costs, I want us to understand what we are out of pocket to provide that product or service so that we can set the right price, right? Yeah. So you're right. All of the commodities, like the consumables, everything that goes in that we don't get back, we should be accounting for it. Even time. Even though we were paying a receptionist to, here's your new client form, please fill this out, and then we're calling to follow up and make sure that you've got your appointment book. All of that is time that we invest in making sure that that client is taken care of, that we would not be putting in that time and effort or materials if that client wasn't there. So that is so important in our pricing piece, so that we can make sure that we're not compromising our profit and the business's security and safety just for the sake of being able to offer a price that the competitor's offering down the road. That doesn't work.
Mm-hmm. Yeah, that makes sense.
Yeah, okay, good. So so don't worry about it for charting the data. Again, all of the historical is just kind of there to go, oh, you know what, it's just to see what the highways and the hazards were. That's it. Okay, great question. Awesome. I love these questions because you know what? I know if you're asking it, everyone else probably has it on their mind too. So this is phenomenal learning for everybody. I think that's why everybody's sticking around. Other questions? Can be related today, to yesterday's exercise, anything. You know what? I need to download an app for Sound Machine. Like, I should have crickets playing right now. Any other questions? All right. Are you sure? Because I'm going to be turning off our webinar if there's no other questions. Let you guys get to work with your revenue streams. But before I go, I see a chat. I'm going to see what's going on. From yesterday, how do you set aside some retained earnings? Okay, so retained earnings, how we set that aside. We can do it monthly, we can do it quarterly, we can do it annually, and basically all you're going to do is retained earnings is what is sitting in your bank account, right? It's your cash on hand. It's what you have retained from all of your income in minus all of your expenses out. It's sitting there. And so this is where financial advisors, this is where accountants will come in handy as well. But usually what I recommend is that you set up a different bank account for retained earnings, like a savings account for your business, and you transfer the funds over there. And then you have to decide what it is that you want to do with it. Most likely putting it into a low risk, right, savings opportunity. Well, this is where I don't want to give you any financial advice on this, but basically you set that money aside the same way you probably have an account right now for all of your taxes, right? So as your income comes in, GST gets taken off right off the top, right? And we're going to talk about later on in this, we're going to talk about putting aside at least 10 to 12% of your money off top, right? So that we can get that aside too into your taxes. So there's no big tax surprise at the end of the year. So you probably have an account just for taxes. And I would love for you to set up an account for your savings and your retained earnings and or any amortization expenses that come up here. So if it's not in your bank account, you're not going to be inclined to go, woo, we have extra money, let's go hire a new person, or ooh, let's go buy the building, or ooh, let's go buy a new piece of equipment. All right, so hopefully that answers that question for you. There was one question that came up yesterday on contingency. Because I had mentioned budgeting for contingency under forecasting for profit. And what contingency is, and I guess I didn't put it here, but I must have talked about it somewhere. Contingency is just an amount of money that you are putting in here to budget for in case something happens, in case something unforeseeable happens. So you don't need to dig into your retained earnings, right? Your profit. It's just a little bit of a buffer. And it's not for anything specific. You can just kind of think of it as your petty cash to have it there in the event something happens. So why we're putting it there is so that when we look for our new revenue goals, like how great will it be knowing that you build this new revenue goal and that when you reach that goal, all of these things are taken care of. It's going to be very, very liberating. I will mention as well, there was a question here. I think I confused everybody with debt repayment. So just to clarify, the debt calculator, the debt repayment calculator is for revolving credit only. It's for credit cards, lines of credit. It is not for your term loans. Your term loans, you don't get to tell the lender what you're going to be paying. It doesn't work that way. They're making money off of you. That's why they've set a very specific term. So you have to honor the interest and the principal that they have asked for you to pay them. That's why we've got loans and principal down here. But credit cards, lines of credit, CRA back taxes, any big accounts receivable that you need to get cleared off, accounts payable, excuse me, those can all go into the debt repayment calculator. And that's where we got this number from, the 2,400. So just so that I'm clear on that for everybody, and that can be your additional expense here. All right. Any other questions, you brilliant entrepreneurs, you? I don't see any. All right. I can see some of you dropping off. Okay, so if you have any questions, you know exactly where to find me. Text me. The texting has been working really well, so thank you everybody for that. And I will see you tomorrow for cost of goods. Tomorrow is a heavy lifting day, just so that you're aware of it. Please don't miss it, because it's there's a lot of details and intricacy that I want to go through with you, so that you are very clear as to what it is that we're going to be doing tomorrow. All right, I'm going to leave it there. You know where to find me if you need me. Have a great day. We'll see you tomorrow, same time, same place. All right, bye everybody.